And we're going to be going over a lot of information because I want to make sure that you have all the information that you need. So we're going to start with what is financing? What different type of loan programs are there? And so we're going to start with conventional financing. And we're going to talk about different financing. As you can see here, we have many different financing options that we can go through. And so really just having a high level of what those are. And then I can give you some additional information and feedback if you want deeper understanding. But conventional financing is really just kind of financing that is private investors, which are like your big investors like Freddie Mac or Fannie Mae. And so those investors are the ones that buy, if you will, these bundles of mortgages, which are considered conventional financing. So it means that the guidelines, in order for you to fit in that box of conventional financing, you have to meet those guidelines. Typically requires a higher credit score, depending on if you're a first-time home buyer or not, may have lower or higher down payment options than government finance options, which we'll talk about as well. It doesn't allow for as lenient credit history as government insured loans do, but it is considered more of a preferred type financing. If you're putting in an offer and you have a seller and a listing agent looking at your offers, they know that a conventional loan in their eyes is a more solid type loan because it's stricter requirements. So if you meet those requirements, most likely you're not going to have really any issues, is what they're thinking. Then you have what's called FHA financing, which is really just government insured financing. So this allows for more flexibility. The government stepped in and said, we need to be able to have more flexible options to allow homeowners to buy and to be able to take part of the homeownership journey. And so government insured loans such as FHA will allow for lower credit scores, lower down payment, and things of those nature. So you have different boxes that you can fit in depending on your requirements. VA is for military. If you have a military entitlement, then it's special financing that can allow as low as 0% down, and has more flexibility and has some benefits such as no mortgage insurance and things like that. So if you have military benefits, military certified, so we can look at your VA benefits as well. USDA is for real property. So it's very specific, and the property has to be identified within USDA property limits, but it does allow for 0% down. So that's an option we can look at if you're in rural property. We do have down payment assistance options. So if you're like, I want to buy, I just don't have the funds to be able to do it, you're in luck. We have a lot of down payment assistance options that we can look and see if you qualify for, that would require little to nothing out of pocket, depending on the type of market that we're in, whether it's a buyer's or seller's market. So we do have those great options that you may qualify for, and you don't have to be a first-time home buyer in order to qualify for down payment assistance either. Jumbo financing is higher loan limits. So if you don't fit in the traditional loan limits that somebody would buy in, and you're in a higher price point, meaning a higher loan amount and purchase price, then we do have special programs for those as well. Those are separate type of investors from any of these. So they have their own requirements that are more restrictive, but we have many jumbo financing options that are super flexible as well. We do have reverse financing. So that's for if you're over a certain age, you're able to use what's called a reverse mortgage, to where you may not even have to have a mortgage payment, or you can get money from your home in what's called draws. So maybe you've done a really great job and you now own your home property, free and clear, or almost. And now, you're on limited income. Social Security is not cutting it. Well, it's a way for you to be able to live in the home and have draws where you can actually have income against the property, or you can have no mortgage payment. So you don't have to income qualify for the mortgage itself, just to be able to afford property taxes and insurance. And so it's a great option for a lot of people that are in the older bracket that need alternative income sources, or be able to have a property that they can live in until, they pass, and not have to worry about finances. We do have a lot of commercial lending, especially for first-time or investors. Even if you're a first-time investor, that has a lot of flexibility, no income qualifying, as long as the property cash flows. So a lot of flexibility around that arena. And then we have a ton of self-employed flexible guidelines. Now, self-employment is very, very unique, meaning that there's a lot of requirements around self-employment, the way we have to document income. But we do have special self-employment flexible products that is our proprietary products that we can offer if you don't fit the brackets of normal standard conventional financing. So a lot of options. So what does it take to buy a home? Really, we're looking at 3 pillars. So when you get financing and you go to a lender, the lender has what's called an underwriter. So an underwriter is a person that is going to be making the decision on your file whether it's approved or not. Strictly, does it meet guidelines or does it not meet guidelines? And so we have 3 pillars that we're looking at in those guidelines really, which is credit, your assets, and your income. And then of course, collateral, which is the property itself that comes after you find a property. So we're looking at all those arenas. The first one is credit score. We pull all 3, your Experian, your Equifax, and your TransUnion. One important thing to know is you may be seeing your credit score somewhere else in a credit monitoring, or you bought a car and you have an auto loan. They're all different algorithms. So the score that we're going to pull as a mortgage algorithm score is going to be different than all of the other scores. So we need to know what the mortgage score is. And great news is if we start the process early enough, and let's say your credit's not there, we can help you on a path, not only educating you how credit works for the future, but also getting your credit scores where they need to be so that you can be able to purchase a home, because they range from 300, as you can see here, to 850. Ideally, we need at least 580 for FHA, government insured loans, but depending on the programs, it can accelerate from there. So we may need to, do some work on your credit in the meantime, which will give us some space to be able to do that. And during the process, maybe even be able to get your credit score up so that we can, get your interest rate and best terms possible with the credit score. So how does your credit profile work? Well, you can see here, you're going to have, several different pillars that make up the credit profile. So you're going to have your history, you're going to have the types of credits, you're going to have the length that you've had the credits. And then of course, it's taken into account derogatory accounts, collection accounts, late payments. All of that causes, whether you have a good score or a bad credit score. So we're going to be evaluating your credit and looking at it. What was the trade line? Was there any late? When did you open it? How long have you had it? Have you been able to, to pay it back? How much is your balance to limit ratio? Meaning, how much are you charging against how much you can charge to ensure that you're making good decisions with your money? Now the next pillar is going to be around income. What type of income can we use? Well, it depends on the type of employee that you are or the type of employment you have. So if you are an hourly employment, then we're going to be looking at your W-2s and your paycheck stubs. If you've been consistent 40 hours and you have a base pay or salary, we're going to use that pay. If you had overtime for a certain amount of time, then we may be able to use overtime and bonus income. If you're part-time and you've had consistent employment, and then we can use an average of your income. Retirement, we can use your retirement, Social Security, disability. Depending on how long you've had your child support or maintenance or alimony, we may be able to use that with documentation and how long it's going to continue. Commissions, we do require a 2 years commission. So if you're a commission employee, we need to see a history to be able to know what is it, what's the likelihood of it continuing and what is that income going to look like. Self-employment, we're going to be looking at your Schedule C, which we all know if it's standard guidelines. And we talked about how we have normal guidelines and then we have flexible guidelines. If we're looking at your standard guidelines, then you're going to be looking at 2 years of your Schedule E on your tax returns, looking at your net income. We can add back depreciation, amortization, some other things that are in there. And that's what we're using. We're not going to be using your gross before expenses unless we use a flexible product that we have. So if it doesn't work on our standard, we can look at the flexible, which may allow for just a profit and loss, 1099s, bank statements. And so we have a lot of flexibility around that where we don't even need the tax returns in those scenarios. So a lot of different options that we can look at for income. Some of the sources that we can't use cash income, gamblings, unless you have a 2-year history, maybe you're a professional gambler where we can show that it's consistent, may be able to use that. And then, if you have part-time employment where it started and it stopped and there's gaps, we're going to need a longer history of being able to show that you've been back to work to be able to use that. Sometimes we can use border income, which means if somebody's living with you, depending on the program, but we can't use undocumented border income either. So a lot of flexibilities around income, but that's what we're going to be evaluating. So the next question is, how much money do I need for a down payment? Well, again, it's going to require, or it's going to depend on the type of program that we're looking at. So if we're looking at government insured loans, FHA requires 3.5% of the purchase price as a down payment. Conventional loans, if you qualify or you're a first-time home buyer, you can put as low as 3% of the purchase price down. If you're not a first-time home buyer, then you would be putting 5% down. VA loans require 0 down, USDA 0 down. And jumbo products, which again is the higher loan limits, depends on a lot of different scenarios. So we need to look and see which ones you would qualify for. So where can the down payment come from? What are the sources that you can use as far as assets? And this is really important because a lot of people have $30,000 in mattress money and we can't document it, can't use the mattress money most of the time, 99% of the time. So we have to be creative in the way that we're able to use that funds, or have to wait a couple of months where you put the money in your account so that it is sourceable. We have IRS tax refunds, which is a great way for you to reinvest the money that you got from the IRS. Checking, savings, stocks, bonds, annuities that are in your name, 401k or retirement accounts that you can pull from, life insurance policies that maybe you've overfunded, we can pull from, gift from relatives or government places. Now, depending on the program, it may allow for, it may allow for friends that you have a close relationship, we could document, but typically it's going to be family, relatives. Proof of sale. So you sold a car and we can show proof and the chain of you selling it and the DMV and printout and all of that, then we can use that to be able to use towards a down payment. Sometimes we can use cash, but it's going to be a case-by-case scenario. But again, we have down payment assistance programs that you may qualify for that may not require very much out of pocket. So different type of ones. We have ones that are grants and we have ones that are loans. So grants means money you don't have to pay back. Sometimes it requires that you're in it for 3 or 5 years and then it's forgivable, meaning you don't have to pay it back. Or they're loans that you have to pay back whenever you sell or refinance the home, but you have no monthly payment on them. So during the entire time that you have this loan or that you're in it, no monthly payment, just when you sell or refinance, those have to be paid off. And depending on the program, they may have a small, simple interest that's added to it or no interest depending on the program. So a lot of different options. My goal as a mortgage planner is to go through and look at those options and figure out what's going to be most cost effective for you. Different programs have different interest rates, different amount that they're going to gift you. And so we're going to look at a side-by-side comparisons based on where you're at to figure out what is it that you qualify for. So this kind of just is a brief overview. It just shows you a standard conventional loan. If you're putting 3% down at $300,000, it's going to require about $22,000 out of pocket. However, if you use down payment assistance, as you can see, the My Home Second is a loan and the Zip Third is a loan that can be used towards your down payment and closing costs. So that would be applied towards it in loans that you would pay back later. So it puts you in a position to where you can come out of pocket with, very little and definitely less than what you would be putting in a standard loan. This is a grant program, or this is the grant program. So this is another one where it just kind of shows you side by side the requirement, but then also how much money you would be getting, out of the down payment assistance. So the next step is choosing the right team advisors. I cannot stress this enough. Not all of us loan advisors are created equal. So as I had said, you have, loan officers, and I was, one of those loan officers 19 years ago that was new in the business and had to learn and get experience as well. So we all have to go through that, but you really want to make sure that you're working with somebody that understands the market. It can cost you a lot of money if you don't. And so making sure that you have the right team is very important. On our team, I have 19 years of experience. I have my loan partner, Christine, who is my side. She's an amazing loan partner. And so we work really hard to make sure that you have a great experience. I am a certified mortgage planning specialist, a certified mortgage advisor, which means I understand the market trends data, which is really important when it comes to your interest rate. Certified divorce lending professional for those that are going through a divorce. I'm military certified for all of our veterans. And thank you so much for your service. And then a first responder advocate. My husband's law enforcement military. I'm a strong advocate. And I also give a first responder credit for anybody looking to purchase. President's Club for many years, which just means that we do a lot of volume. We help a lot of families and we're able to provide the great service and make sure that we know what we're doing because we're able to produce it and move forward. So you definitely want to look at reviews. I think it's really important whenever you're working with anybody, you should be looking at their reviews. How well have they worked with other people? And so you can go and you could just, search Kristen Cooper and you could find me out there. You're going to see tons of education videos and reviews that are out there so that you can see from everybody else the way that our team works. And I know that, if you have any questions or that you need anything, I'm always just a phone call away. I want to make sure that you have all the information you need, and I'm not going to harass you. I'm not going to tell you that you have to buy right now. I'm going to give you the education resources and hopefully a home buying plan if you're not in a position to buy so that we can help you on this journey long term. So if you or anybody any family or friends are looking to buy and just want some additional information, or maybe someone like they should buy, they're not buying, but they need to buy, send this presentation over to them, send this video over to them so that they can reach out and that they can get the information that they need to make smart, educated decisions. And if you need anything, again, KristenLoans.com. Thanks so much for watching. Appreciate your time.